All right, so we're seeing a little bit of a bounce in the pre-market right now when it comes to futures, but we're kind of on a slide when it comes to Wall Street overall, if you look at the longer trend. With that in mind, what is your word of the day?
So my word of the day, I think, is fairly fitting. It's angst. Frankly, that is the sentiment that we've had since the year has kicked off, and perhaps even a little bit prior to Christmas as well. And to some degree, Frank, that's normal. That's seasonal. This is just what we see in January, which is some growth in volatility and a sell-off in the market. You've seen that every single January for the last decade, and so it's not surprising that you're getting a little bit of this January as well.
All right, so according to your data, the jobs report actually added to some of the angst out there on the market. So you say before the jobs report, S&P hedges were in the 50th percentile. Now they're in the 75th percentile. Give us that in plain English. What does that mean about sentiment in the market?
Exactly. A really simple way to think about that was after that blowout jobs number, I think people just had to rejigger their framework. If they had expectations for multiple rate cuts this year, a lot of that was pulled back. Our own rate strategist actually thinks, we're more in the camp potentially of hikes coming up this year. So really different change in framework. And what that's done is made people evaluate how much upside is left in the S&P. Are we at valuation levels that are perhaps nosebleed? And could it pay to have a little bit of hedges at this point in time?
All right, with that in mind, Amy, you have a pick for us today. What is your pick and why?
My pick is QQQ puts. So NASDAQ puts, you can own that in the February timeframe or March, because that'll help you capture the Magnificent Seven earnings. And this is a really simple idea in the sense that we've seen overall hedging levels decline because of the exuberance we saw last year. So hedges, even with the crawl up since the payrolls happened, they're still not that expensive when you look to history. You have a lot going on, and most of that weightiness, Frank, still lies within the Magnificent Seven. This is a simple way to protect that, and by protecting that, protecting the overall market because of how much weight is still left in that mega cap tech space.
Amy, a lot of talk about the idea that rising bond yields are not only putting pressure on equities, but they're also providing competition for equities. Rick Reeder from BlackRock, he was on our air yesterday. I want to play a soundbite from him and just get your take on that.
I think what bonds are today is you own shorter term bonds, you clip a bunch of income, marry that to equity, and I still think tech stocks, growth equity makes a ton of sense.
So I know your wheelhouse is really options, but are you seeing people play the markets that way, looking at the short end of the bond curve for opportunity and still being bullish at all when it comes to mega cap tech and growth?
I do. Look, Rick is a smart guy, and one thing he said that is really interesting, because we've seen this play out in derivatives, is to some degree, Frank, you just have to be in tech because tech has become such a large proportion of the market. If you miss out, you miss out big. We saw that the last few years with folks, investors who we talk to who are underweight tech, essentially have to chase that upside when they realized they were going to really underperform their benchmark by owning call options. So that duality exists. Now, the one sentiment shift I would say right now is people have already become quite long that tech side. And so that's why I think hedges are an interesting play now, because we're far more long coming into this year than we were coming into 2023 or 2024.